Today, my guest is Jerry Fetta. Jerry, welcome to the show today.
Hey, thank you so much for having me on today, Nick. It's a real pleasure.
Yeah, we're really happy to have you on. Would you mind giving the 411 to our audience of who you are and what you were going to bring to the show today?
Yeah, thank you. So I own a company called Wealth DynamX, and what I do with my company is we help families and individuals become financially educated. We help them build wealth with the entire purpose of them being able to navigate their economic futures with more certainty. And so we help people with, taxes, investing, saving. If it has a dollar sign in front of it, we pretty much can help out with it.
That's great. So you're really helping families with financial literacy is what you're doing then.
For sure. Yeah, definitely.
And how did you come to that? What's your background that's brought you to this business here?
Yeah, so I've been doing this for almost 10 years now. So I got into the financial industry at the age of 18, and I was kind of a traditional financial advisor. So I was helping people with, stocks and bonds and mutual funds and that type of thing. And I just kind of grew from there and continued to learn, about what was out there and expand my knowledge. And, almost 10 years later, my company is vastly different from where it started, but still in the same industry, helping people with the same basic purpose.
And did you go to school as well?
I didn't actually. I did go to high school, so
okay,
no worries there. But I did the industry. I mean, you go through several rounds of state and federal licensing. So I did that, but I didn't do college or anything like that along the traditional route.
Yeah, and I think that's something I found from a lot of different entrepreneurs is, it really doesn't matter where you started; it's where you finish. And I know myself, I didn't go to college either, and I kind of always wear it as a badge of honor. But at the same time, when my kids are getting close to decide, I push them towards college. So I guess it's all a matter of choice, I guess.
Yeah, I think so.
And then, so what do you find the keys that you kind of guide families towards today? And I think, maybe where we could take the show that'd be really interesting to our listeners is you have a lot of business owners listening. Like, what are the type of things that they should be doing? I think with COVID going on too, a lot of business owners have taken a financial hit. Like, what are smart choices and what are some really dangerous choices businesses and families would be making right now?
Yeah, so that's a very good question. And if I'm talking to a business owner as a business owner as well, my viewpoint on this is I really have to almost get rid of the idea that being a business owner as a title means something. Because at the end of the day, to build wealth specifically, I've got to have profit. So regardless of my title, my thoughts about my business, how long I've been around, whether I'm brick and mortar, whether I'm online, I have to generate profit. And so that really is where I try and focus business owners' attention on it can, I see it a little bit with the college degree where somebody has that piece of paper, but it doesn't mean they're employed and it doesn't mean that they're working in the field they did go to school for. And it can happen the same way for a business owner where we can become a little bit entitled with what we've done, what we've built, which is great because it's our baby. But at the end of the day, something like 2020 happens and we've got to be able to adapt and be willing to make changes to still make money in an environment like this. So I think that's the mindset. I think the very dangerous, like you would ask, the dangerous way to go about it is to rely on either my past successes or for assistance from others. If it happens, great, but it's a business, not a charity.
Right. And then when you built your business, what were the struggles you went through in the beginning of building it? You said it's very different today than it was in the beginning.
Yeah. So for me, I think my biggest struggle was I was starting at 18. So, I was 18 years old and I was telling people that were in their 30s, 40s, 50s, and 60s what they should be doing with their money. And so naturally that was kind of, something, and it was my own self-created struggle was the credibility aspect. And I had a lot of attention on that myself. I don't know that my clients actually did. I think, at the end of the day, if I could do a good job, I could do a good job. But that was one of my struggles was just dealing with that and trying to, overcome my age. And a lot of it too was because I didn't get any formal schooling, and I didn't necessarily get into business on purpose. I didn't really have what I would say like qualified knowledge. Like I would read books and I would kind of just do whatever I learned. I didn't know who wrote the book and if they were successful at it or if it was just something that they wrote to sell a book. So I went through a lot of ups and downs in my business, just trial and error, testing this thing, finding out it doesn't actually work or I was doing it wrong. And so there was a lot of that for me. And about 4 years into it, it finally clicked. And I actually got rid of a lot of stuff. I removed a lot of the information that I had accumulated, a lot of the data that I had picked up. And then my business really did start to get traction.
And you said that you overcome the hurdle of your age. Was it a mindset matter too, that you had to really convince yourself that, hey, I do know this stuff. I'm not gonna. It was almost like, from what I was hearing, that you let your age get into your head.
Yeah.
Yeah. So how did you overcome that? Like, what different mindset did you have to take to get through that?
Yeah, good question. So that was very much it. I never actually had, maybe but once or twice, a client or a prospect say, hey, because you're young, we're not going to work with you. So it was really self-created. For me at the time, I had a manager sit down with me and he basically pointed out with professional athletes. He said, hey, if you look at LeBron James and you look at Tiger Woods, they both signed multi-million dollar deals with Nike. He's like, do you really think Nike cared about what their age was? And I hadn't thought about that. I was like, well, no, they didn't, because they were that good. And he's like, exactly. So if you want to overcome this age thing, you need to just be that good. And I took that to heart. I started studying, listening to personal development. And even to this day, you'll always find me, learning, improving, striving so that, age doesn't become a factor. Because on the flip side, when I'm an old man, age could become a factor again if I let it. Versus if I'm just that good, no one's going to care if I'm 95 years old. They know that I'm that good.
Right. And as you started to grow your business, was there other points where you had to kind of realize and get over to and shift your mind in a different way as well? Kind of shift your mindset?
Yeah, there definitely was. Being a business owner, I learned a lot of the stuff that I grew up with, the social norms, the societal niceties, the politenesses, the socially acceptable stuff that you're just kind of supposed to do or not supposed to do. I learned a lot of that stuff doesn't actually work in business. And so I grew up with these different, mores and beliefs and ideas that I was very emotionally attached to because I learned them from my parents and, my friends and my teachers. And so I had to really be willing to inspect my own viewpoints and realities and really be able to filter out what was actually yielding a result and what wasn't. And if something wasn't working, I had to learn to be emotionally unattached and willing to just get rid of it.
Yeah, and I think that's part of growing your business too, is you're growing yourself, right? And you're speaking about how you're a constant learner now. Have you always been that way? Always learning through this whole process?
As soon as I got into business, yes. But prior to that, through high school, I don't think from the age of 19, probably back to about 13, I didn't read a book. And it all started in eighth grade or ninth grade when they have us start doing these book reports. So I remember sitting there and I was in English class and they pull out Shakespeare and Gilgamesh, two of the classic books everyone reads in high school. And I'm looking at this and I'm like, what is this going to do for me in my life for me to understand what this book means? And so from that point, I kind of gave up on reading and learning because I was like, I'll figure out how to pass the tests and get a C, but I'm not interested in any of this stuff. So around 18, 19, I got into business. And then I remember picking up my first book, probably since, early high school, late middle school. And it was different that time because it actually was something I wanted to apply. And so I was willing to listen and learn and go through the work of studying. And it just, from that point onward, as soon as I got into business, it really became a constant thing.
Yeah, I think what you're saying is important. And then, the material, like you had mentioned, is important because you're right. Like, you can just read a bunch of books, but if you don't know who the authors are and really where they came from and what context it's really in, it can be kind of scary or what you're learning. So I think, to recognize that too, when you were younger, to say, hey, I've got to make sure I'm reading books that are credible. Kudos to you. I think that's super smart as well. Is there some books out there that are your absolute favorites that you think anybody trying to learn about financial literacy should be reading?
Yeah, there are some. So basically, I have several that I like, but I like to tell people there's a book by Nelson Nash. It's called Becoming Your Own Banker. And Nelson Nash, he passed away a year or two ago, but he really in the alternative investment world, in the alternative finance world. When I say alternative, I mean he's not in Wall Street and banking. He really is looking at how do the actual wealthy people make money, not how is the middle class told we should make money. In that space, he's kind of a founding father, and so that book really goes into how to become your own institution for things like banking and lending, and that way you're making money on your money rather than paying interest to banks, and that's a great start.
And then what do you think of like classic books like The Rich Dad Poor Dad?
I like Rich Dad Poor Dad as a concept. I'm not a huge Kiyosaki fan. Just his views when I kind of see him, it's just not something I'm interested in. But the book, I remember learning that early on in my career, and what helped me a lot out of that was the cash flow quadrant. So there was a lot there, but when I saw the cash flow quadrant, that was something that I was like, okay, this is just simple and I can do it and make sense. And I can see it around me. I can look and see, yeah, there are employees and there are self-employed and there are business owners, there are investors. And it does seem like that right side of the quadrant does better than the left side of the quadrant. So that was one that I read early on, and that was really what I got from it. And if I were to reread it again, I'd probably get even more out of it. But that point really has stuck with me.
And then you wrote your own book just recently, correct?
I did. Yeah. Let me pull it up here. I've got a copy here. So this is called The Blueprint of Financial Freedom. And this really is a write-up step by step of what anyone from any stage they can start, at the very beginning or halfway through. And the entire goal of this book is to build passive income that exceeds savings, expenses, and taxes. And so it kind of shows that as the end goal, but it works its way backwards on, okay, well, what would you do in order to get there? And it basically gives you a recipe. If you follow these steps, this is how it works, and you'll naturally get to that next step and end up with passive income.
And I think for a lot of people, that's, the goal is passive income. I think for a lot of entrepreneurs, and I think that's sometimes what separates businesses is, people have their own business, but really they're just self-employed. And I think there's a big difference between being self-employed and running a business, right?
Totally. Yeah. It's phase one versus I have a job. Phase two, I provide employment.
Yeah, absolutely. And on your journey of learning the different aspects of financial literacy, are there some points where you really researched that maybe surprised you, like of way things work? Was it maybe the taxes, or was it really understanding how interest rates work? Was there something that really opened your eyes and was like, if more people understood how this worked, it would really change lives?
Yeah, there's there's several of those. So to provide some context, when I got into the industry, I took my insurance exams and my investment exams. Those are all state and federal. And so they're written by, exam providers, and those exam providers study the tests and they create the curriculum. And I thought I knew everything. At 19, I have all these licenses, and I'm like, man, I aced them all. I have all these licenses. Most people don't know any of this. So I thought I was like educated, and I had knowledge, but I didn't have results, right? So I had all this information, but it wasn't actually like I was winning with money at the time. So I sat down with a mentor of mine. This was probably when I was 19 years old. And he's one of my friends and family, warm market meetings. And I go to pitch him on my product, and he sits there and listens. And then when he gets done, he basically re-explains the product back to me, but he does it simpler than I did. And when he explained it in a more simple fashion, it actually sounded like a bad idea. And so I'm just shook, right? And at the end of the meeting, he stops me, and I'll never forget this. He goes, Jerry, when you're ready to learn how money really works, I want you to come talk to me. And I was pissed. I left the meeting, disregarded him. But when I started to think about this several years later, it really started with understanding, what happened in 2008. 2008, I was in 10th grade. So it was not something I was actually involved in and lived through. And so it was kind of like my parents did. But when I got out of school and got into the industry, I was like, well, let me research back and actually find out. When I started learning about how controlled and manipulated and intentional 2008 really was, it made me stop and take a look at all of these products I was selling, mutual funds and annuities and stocks and bonds. And the further I dug, the more I learned there's real information that wasn't on my exams. And so when I learned about that, I was like, wow, this is a paradigm shift. So that was definitely a big eye opener. One of the things I came away with is I started actually researching what the top 1% of wealth historically have done in order to build their wealth, and seeing just how different it is from what's advertised. You know, you watch CNBC, you see, you know, Schwab and Fidelity and Vanguard and all these different funds and companies that you're supposed to put your money into. The wealthy don't actually use any of that stuff. And so when I started learning about what do they actually use, that surprised me more than anything, because it's either untalked about or it's things that we're told don't do that. You know, it's a scam, or don't get involved with that, or it's too hard or too difficult.
I think you probably raised some ears right there. There's probably people out there that, you know, they keep their money in mutual funds or something like that. Or what do you recommend instead if it's somebody that invests in the stock market and that's what they've been told, so that's what they put their money into? And I think for a lot of business owners, you know, they've either, you know, most of them have kind of emptied it and put it all into their own business, or they just kind of say, hey, I'm going to, you know, all my money's in on my business, and they bet on themselves. But I do think that there's a point where some people, at some point, business owners have some money in the stock market too. And maybe they think, I run my business, so I really don't want to do anything but pay a broker to keep money in a fund, and that's it.
Yeah, so that's a very good question. For business owners, you know, the business will always be a good investment. However, what I like to point out, and I am a business owner, so it's not like the financial advisor that doesn't own a business that thinks you should do X, Y, and Z. Invest in your business, but realize every single business at some point in time will fail. There's never been a business in the history of the world that stayed around forever, right? So with that being said, when a business owner gets to a certain point, it is time to start taking profits from the business and converting that into assets. And these assets are typically going to be things like real estate, and I like to invest in hard assets that I can see and tangibly go, you know, touch and feel. Those ones will last forever. You know, a property is going to be around for quite some time, versus a business, you know, who knows? So that's something that I would say is definitely a point to look at as a business owner. If somebody is investing in mutual funds, I would usually start with the question, Nick, of do you actually understand what you have?
Mm.
Most people will say yes on the surface, but when I point out what's in a mutual fund is a fund, and it's part of a fund family, which is going to be a Vanguard or an American Funds or Fidelity. Each of those funds is going to have a market capitalization. Do I even know what that means? Inside that market capitalization, there's going to be sectors. Inside of those sectors, there's going to be holdings, and each of those holdings, you know, is a company, and that company has a balance sheet and a cash flow statement. And I need to understand, as an investor, if I buy a property, I want to see the balance sheet and I want to see the P&L. But all of a sudden I'm in Vanguard, it doesn't matter. Yeah. So if I have, you know, 5 Vanguard funds and each of those has 20 holdings, I'm investing in 100 individual businesses. Do I actually know what's there?
Well, I think a lot of times, you know, someone will say, you know, oh, I've got stocks. Well, what do you have? I have 401k. Okay, well, what do you have in your 401k? Well, I have a 401k.
Yeah.
You know, and it's like, yeah. Okay. And you're right. Like it's kind of like in school, they definitely didn't teach any of that. So if you're not a constant learner when you get out of school, or if you don't have a good financial advisor who doesn't just take your money and invest it, but they also teach you, I think a lot of people don't find that comfort level with maybe picking their own stocks, or, you know, even if they still want to be in some sort of funds, being an ETF rather than a mutual fund. Like, I think they just don't understand how everything works, I guess. And that's kind of where, you know, why you have some of these big mutual funds that are, like you said, you turn on CNBC and they're advertising like crazy, because it's, you know, they just kind of are sucking off people that don't have the information.
They make quite a bit of money doing it too. The deal with the mutual fund, again, I like to simplify things, because in finances, the way that it gets away from most people is not through finances, it's through vocabulary. Finances is just numbers, right? You know, it's addition, subtraction, multiplication, and division. And if you know those 4 things, you can pretty much make your way through any financial statement you look at. But it's the vocabulary and the nomenclature that gets used where people are, you know, that's over my head, or I don't know what that means. And then they just glaze over and hand it over to the professional. So, you know, at the end of the day, if you look at a mutual fund and we look at it from the standpoint of, you know, if you're investing in my mutual fund, it's kind of like you're loaning me money and I'm speculating with it. So I'm not actually guaranteeing you anything. And they're very specific about that in a mutual fund is there's no guarantee of performance. Past performance does not indicate future performance. So you're loaning me money. Now, in a traditional scenario, if you were loaning me money, you would be charging me an origination fee. But somehow Wall Street flipped it where I'm charging you a front end load. So I'm charging you an origination fee for the privilege of loaning your money with me to speculate with it. And there's no guarantee of anything except for one thing, which is I will charge you an annual fee.
Yeah, and I think that's where a lot of people get confused too, is they don't realize that, you know, over 40 years of being in there, 30 years of being in there, what those fees have really taken away from what they really would be left with at the end. You know, if they really worried about the fees, I mean, it's really dangerous when you get into it, because at the end, once that compound interest starts working, you know, it works miracles, they say. But, you know, when you're paying all those fees and you realize, okay, it was only, you know, 2% or 1.5%. Well, that just, you know, that it wasn't just 2% that you lost at the end. It was a lot more because of the compound interest.
Yeah, you know, and it adds up to about a third of the balance.
Yeah.
Right? If you take a 1 to 1.5% fee over 30 years, about a third of the balance of that fund goes towards fees.
Yeah, which is unbelievable. I don't think it sounds crazy when you say it out loud, but I don't think a lot of people realize that at all. So when you say hard assets, what kind of assets do you preach?
So my favorites are life insurance, real estate, and then gold and silver. And there's certainly other ones out there. Those are just my 3 pet favorites, just because I like them and understand them quite a bit. But those are the main ones I put my money into. And it's typically where my clients do too, is as I go through and explain with people the order of magnitude of earning, saving, and investing, and what each function does and where you can put it. Those usually are the 3 most simple and relied upon, you know, historically, as far as assets can be concerned.
With life insurance, do you like a full policy?
So I do high early cash value whole life insurance policy. I call it the sacred account, but it's basically a whole life policy where you minimize the amount of money that goes towards your premiums and death benefits, and then you maximize the amount of money that goes towards your cash. And by doing that, typically your cash value is going to grow at about a 3 to 5% compounding annual growth rate, tax-free. And I can borrow against that cash value at a 1 to 3% effective interest rate and still have that 3 to 5 growing. And then I can use that money I've borrowed to go invest in real estate. I might make 10 or 12% on the real estate too.
So it really just becomes another vehicle is basically what happens. And that's like when we're talking about, you know, making it work for yourself, you know, you're using money from your life insurance policy as your bank rather than going and paying the bank interest. So you flip the script there, right?
Exactly.
And then when you talk about gold and silver, do you like to hold the physical gold and silver? Or do you like to hold funds that do the gold and silver? Or do you like to, you know, go into some of these places that they actually hold the gold like off site? Or do you like to have physical gold? Do you like the coins, or do you like to get just regular bars, or what do you recommend there?
Yeah, so I do a couple of different things. If it's smaller denominations, then I'm going to buy it and usually hold it physical. And obviously I have a safe and I hide it and all those things. What I like to do as well is I like to do something similar with the life insurance. If I have larger sums, I can actually take a collateral loan against my gold. So at that point, I'll buy, you know, $50, $100, $200,000 worth of gold and silver and borrow against it. In those scenarios, I do keep it at a secure vaulted offsite depository. And so they hold it as collateral. I borrow against it. I can use that to produce cash flow and income. And then if I ever want to take possession, I just pay my loan off and request the gold and silver back. So it's usually going to be one of those two. You know, I don't really like doing, you know, bank depositories or things of that nature, because for me, the whole point is to get out of the bank. So it doesn't make a whole lot of sense to buy gold and then give it to them.
What kind of interest rate do you end up having if you do something like with the gold you were talking about?
As far as a cost, or you mean what am I earning?
So like, so if you buy, walk me through again, because I don't want to say you lost me, but I think it's an
Yeah.
interesting concept that you brought up. So when you're talking about buying $200,000 worth of gold and then borrowing against it, like how does that work? And how do you like, do you pay an interest for borrowing against it?
Yeah, yeah, you do. So I'll buy, just for math's sake, let's say I buy $100,000 worth of gold. Typically I can borrow about 75% of that. So I can borrow about 75 grand. Now, granted, that 100,000 is still earning. So over the last 20 years, gold has done about a 10 or 11% annualized return. So I'm making, approximately that on the gold itself. I'm borrowing the 75. The 75, the interest rate is typically going to be about 4 to 5% interest only. And that's if I don't pay my loan off early. If I pay my loan off in monthly increments with my cash flow, then my effective rate might be closer to like 1, 2, or 3. So it's somewhere between that range. And then I'll take that money that's costing me, let's say, an average of 3%, and I'll go invest that in a real estate deal that's going to pay me 10%. That cash flow I get from the real estate deal, I automatically pay my gold loan off with that every month. So it's just an automated pays the loan off. It's a line of credit, so it becomes available again. And I can recycle that back and forth as many times as I'd like to.
And when you're recycling it, do you ever just take that gold off, take it away and say, okay, I now have that $100,000 worth of gold and just start the whole cycle over, or do you keep using the same gold as collateral?
So I'll usually add to it, right? So I've got my earned income and I'm always saving that into either gold or life insurance. So I'm going to add that as I go. And so that 100, as I grow that line of credit by buying more gold, might grow to 125, 150, 200. I am somebody that wants to own gold. So I'm not of the mindset of trying to sell it at a certain price or flipping it or trading it. So there's not really, for me, a circumstance where I'm going to sell it. Because the other thing that happens is as long as I borrow against it, I never pay capital gains tax. The IRS cannot tax a loan. So if I'm borrowing and making a profit spread, that's to me better than selling because I can capitalize on the increased value, but not pay any of the taxes.
And then what about silver?
Silver, you can do it with too. Silver for me is a smaller weighting when I'm borrowing. So gold and silver each have something called a standard deviation. And a standard deviation means on average, how far could we expect it to move up or down? And so gold has a standard deviation of about 15. Silver has a standard deviation of about 25. So if I'm borrowing against silver, it could drop 25%. Well, if it drops too low, I might get a margin call on my loan, and then I've either got to pay it off or buy more. And so for me, I don't like that a whole lot. I like silver from just a buy and hold standpoint because it can, 2020, March 2020, it dropped down to 12. I bought a bunch of it. Now it's worth 24. So I can double my money like that with silver if I am in the market at the right times, but it's not really a stable, consistent asset the way that gold is.
I think we definitely see that where you see gold has gone up, and even 2 years ago when it was around that $1,200-$1,300 level, it was there for a long time. It wasn't like just a month or two. It was there. Now where it's 1,900, it's been there for a good bit of time now. And I think I think sometimes when people are trying to figure out where to invest their money, they hear about gold, but maybe it seems like an old way to invest. So maybe some people don't think of that. But I like what you're saying about the hard assets. And then what about like people that do want to get into the stock market? Is that somewhere that you kind of steer your clients away from, or is there a purpose for that as well?
So for me, I personally, I don't do anything in the stock market. It's kind of like working in a restaurant and seeing what goes on in the kitchen and then not wanting to eat there ever again. So that's kind of how I feel about it. Now, for the average person, if you do want to invest in the stock market, realize doing it in mutual funds, in ETFs, in all of these various retail financial products, you're buying the leftovers. So it's kind of like soup of the day. It's not the good stuff. You're getting it after the IPO is done. You're getting retail, shares. There's markups. You're paying all these fees. So institutions that invest in stocks, and I kind of break it down like this, the 4 groups that should invest in stocks are going to be day traders, market makers, institutions, and then typically like Wall Street themselves. Right. And so if you look at it from that standpoint, I've got to figure out if I'm going to invest in the stock market, I've either got to be in one of those groups or I've got to ride the coattails of one of those groups. I've got some friends that do trading and they're great at it, but it's not, like you said, it's not a business, it's a job. They spend 4 to 6 hours a day in front of a computer. So it's definitely not passive. If you study the top 1%, when they invest in stocks, they typically do it through hedge funds. And so that puts you in you know, those categories. You're at that point, you're an institution or you're a market maker or you're actually a fund on Wall Street. And a hedge fund operates very different than a mutual fund. So, you know, if I'm going to start as a little guy and I really want to do well at it, I'm probably going to be a trader and I'm probably going to have to learn that skill and do that job. If I'm an accredited investor and I've got a net worth of over $1 million, then I could do that as a hedge fund. And that really is where the wealthy people, you know, they make the bulk of their money in the stock market through hedge fund investing.
And what about tax strategies that you preach? What are some of those?
Yeah, so I own a tax firm as well. You know, for me, I look at taxes as for the average person, if I don't have debt, like if I don't have any consumer debt, my next 2 biggest costs of living are housing and taxes. Right? Housing always going to be there. I need to live someplace. Taxes are something I can do something about. What's unique about taxes is the tax code itself. If you look at the real laws, not the court cases and amendments that are in there, just the actual laws, it's about 6,000 pages in length. And only about 0.50% of the entire 6,000 pages are about how and why you have to pay income tax, which means the other 99.50% is getting out of paying income tax. So people don't realize that. They think the tax code, they think the IRS, and we kind of get into this big bad wolf mentality of like, oh, we don't want to mess with them. What a lot of times people don't realize, and I didn't realize, is the tax code was passed by Congress, but it was not written by Congress. It's typically written by attorneys that are hired by the top 1% that then lobby their bill into Congress and get it passed as law. So the people that don't want to pay taxes freaking wrote the tax code. If you study it, it is full of information that you would never guess is there about not paying taxes. So it is something where I study it. I recommend everyone should know it, learn it, understand it, work with a very proactive tax firm, which is what we do, not reactive, meaning, you know, here's what you earned, here's what you have to pay. If you can, max out your IRA. There's a lot of other stuff you can do before the tax year ends to get rid of taxes and reduce that down substantially.
Yeah, I think, you know, for a lot of business owners, you know, in the beginning, they're worried about how do they make money. And then when that happens, it's like, how do I keep the money? And I think that's where, you know, a good tax firm, a good CPA definitely comes into play.
Yeah. And it's a very fun game once you understand the simplicity of what you're trying to do to avoid taxes and do it legally.
Yeah, and well, that's the key is you got to do it legally and make sure you're doing it the right way. But yeah, there's a lot of there's definitely a lot of strategies that you can use. And as a business owner too, isn't there a lot of things that are written for business owners in there as well?
Yeah, the bulk of the tax code it's very hard to reduce taxes as a W-2 employee. So if I'm a business owner or even just a sole proprietor, that's really what the bulk of the tax code addresses. And that's where the bulk of my deductions and opportunities are going to be found.
And Jerry, take us through your book a little bit more. Like, why did you write a book? How long have you wanted to write it? What's in it?
Yeah, so it's my second book. I wrote the first one about 2 years ago. And the first one I have here as well, it's called How to Create Wealth. It's kind of a little booklet on just, you know, things that people should know that typically are never taught. But this one really was the blueprint to financial freedom. It really was about giving people organization and clarity. And so what I run into day after day after day is there's so many financial tools that we can use. There's mortgages, there's 401ks, there's mutual funds, there's everything under the sun. And so people kind of just look at all of them as good. It's kind of like, you know, like I'm making a bowl of oatmeal and potentially all of the ingredients could be good, But if I put all of them in, let's be honest, the oatmeal is probably not going to be good because I put too many things in it. So I see people that, they get the house just because it sounds like a good idea, or they get the 401k just because it sounds like a good idea. They don't have a rhyme or reason for why they got it, what they're going to use it for, the order that they got it in relation to the other financial products and services that they have. And it really ends up kind of dispersing them and ultimately stopping them from becoming financially free, because now they're slave to all of these products and stuff that they don't really understand. So the book that I came out with, The Blueprint to Financial Freedom, was really focused on three things. I wanted it to be simple, I wanted it to be true, and I wanted it to be applicable. And with money, simple, true, and applicable means it's going to work. And there's a lot of stuff out there in the industry that's not simple, a lot of stuff that's not true, and a lot of stuff that sounds great, but it's not applicable. I can't do anything with it. So this really just gives people a simple, true, applicable pathway that if they follow it, it's going to direct them through, okay, when do I get a house? How do I do my mortgage? Why would I do it that way? Should I do the 401k? If not, why not? And what should I do instead? And when should I do that? And it just takes you all the way through to the top of, actually becoming an accredited investor and then becoming financially free.
And I think when you're talking about the books that you've written, the businesses you've created, and still at such a young age, like, where does the drive come from, Jerry?
That's a good question. I think for me, it is just something I enjoy. Like for me, there's not a chip on my shoulder. There's nobody in my life I'm trying to prove wrong. It's none of those things. It really is like, for me, I prefer to do this. Given my choice of activities, I like work. And so I'm going to usually pick my business and it's just the joy of creating and putting a product into somebody's hands that actually helps them. And so that's something that just is an internal enjoyment inside of me. I don't know where it comes from or I don't think it's ever going to go away, but it's just something I like doing.
And do you find a lot of happiness in teaching others too, and families, and seeing them become financially free?
I definitely do. It's one of our main focuses. And so for me to teach somebody a concept and see them get it, and then also see the result of that, is one of the best feelings in the world. I have that, day after day after day with my clients, where we just do incredible things with them. And what I love about it is we teach it and allow them to do it instead of doing it for them. So we're it's more work for sure, but it's more empowering. And they actually, they learned to fish instead of us just handing them the fish.
And the team that you've built around you, could you tell us about the team you've built around you and around your business?
Yeah, so it's very extensive and it can seem a little bit complex, but so we do everything from investing to life insurance to taxes, estate planning, legal, all of everything you can imagine, and it's really modeled after a concept called a family office. And if you study the concept of a family office, it's something that, again, the top 1% use. I was a financial advisor, and at the time I was a financial advisor, I did not know what a family office was because I was a financial advisor. Most people use a financial advisor instead. So we have our internal staff that really work on running Wealth DynamX, servicing our clients. And then we have various other companies that we own, work with, partner with, and we have connections and staff there as well. And so really, it's kind of like my company, Wealth DynamX, is like the family office or the quarterback. And then we have all of these different directions we can go with people. And we've got, a network to work with everything you could imagine financially in order to get those services implemented for people as well. But it's very nice because it's centralized. So it's not like they have 15 different people and all of them have their own ideas. It all comes back to our plan with them, and everything is running through that.
And when you talk about businesses opening up, or when maybe people start to get into real estate, how important is it to have different entities?
Super important. So most people don't understand entities. They think, LLCs are for taxes, and really an LLC is considered a disregarded entity. So the IRS doesn't actually care about your LLC. They don't even acknowledge that it exists. It does protect you from liability, though. And so that's really a component that's important to look at is if I own real estate, there's potential liability with that real estate. And it's kind of like dominoes. If I hit one domino and I don't have liability protection through those, LLCs and various entities, then all the dominoes could fall. So by using entities, trusts, LLCs, anonymous LLCs, I can start to separate those dominoes to where if one falls, yeah, that sucks, but it didn't hit all the other ones.
And I think that's important for a business owner, when they start to open up more businesses, to realize that you don't want to lump them all together. Wouldn't you say it's super important?
It is super important. And I definitely understand why people still do it anyways, because there's definitely a complexity of having another bank account and another set of books and another tax return. So I always tell people, as from the standpoint of owning a tax firm, like really understand what you're doing there and ask yourself, is it worth it to open this other business right now? Or should I just focus on the main thing? And if you're willing to do the bookkeeping and all the extra stuff, then totally let's open more entities. But it definitely is something that has to be organized, looked after, and done right.
Yeah, because I think you're right. If you don't take care of it, and then you're kind of backpedaling when something does happen and going back and looking at different records, you can find yourself in a lot of trouble if you weren't keeping up with it throughout the whole process.
Yeah, I think an unorganized entity is a liability. So
Yeah.
if I'm trying to defend against liability by using another liability, it kind of cancels itself out.
And how about a business owner when they're trying to decide LLC, S-Corp, C-Corp? What kind of tips do you give somebody to pick through that process?
Yeah, the LLC, like I mentioned, is a disregarded entity. So the IRS by default is going to look at that person as a sole proprietor. So from the standpoint of like just having a business, I think you should have an LLC either way. Now, if somebody's looking at, do I go from a sole proprietorship filing LLC to an S-Corp filing LLC? The real question there is about profitability and commensurate pay. So, S corporation has to pay a base salary, and that base salary has to be, somewhat loosely based on what would you pay someone else to do that job on industry standard pay. So if I'm making less than industry standard pay as a sole proprietor, then I don't really need to worry about an S corp yet, because I'm not going to get any effective tax benefit. But let's say my industry standard pay for this role I'm in is 40,000 and I'm making 200,000. Then it makes a lot of sense to do an S corp. With an S corporation, I can actually avoid self-employment tax on anything above my base pay, versus a sole prop. I'm going to pay income tax and self-employment tax on the entire thing. So that's kind of the deciding factor there. Both of them are still going to get plenty of tax opportunities. You do get more with the S corp, I would say, and so that's another thing to look at. But it really is going to be the right move when you're past that base pay level.
And then what about, we just had the election, and we're going to have a new president more than likely. And then, what do you tell people when they're worried about, different tax codes that will come in with a new regime and stuff like that?
I mean, it'll change. It's kind of like asking what the stock market's going to do. Nobody really knows until it happens. What I like to point out is in 1913, which was the first year we ever had the IRS, the highest tax bracket was 7%. Okay, today the highest tax bracket is 37%. So that's an average compounding annual growth rate of about 1.5% to 2% a year. So regardless of who's president, you can expect taxes to go up by 1.5% to 2% each year. It won't happen year by year. It'll happen little by little, and all of a sudden the rate went up, right? So ultimately there will be different policies and rules and regulations that get passed, but they're all going to be in the name of increasing income tax incrementally. And, we still need to avoid them through legal means, regardless of who's president.
Yeah. And I think you just said it very good there. A lot of people get worried when they start to see that, when presidents switch and different powers come in, different parties run the House and the Senate. And I think you're right. Like, you have to really almost go on defense and make sure you're doing the right things and talking to your accountant. And, how often do you tell your clients to make sure that they're on the tax side, that they're talking with you? I'd imagine it's not just, hey, let's see you in the second week of December to talk about what just happened in the last 12 months. Like, how often are you meeting with them and talking with them, the plan?
Yeah, it really kind of is on an as needed basis. So we don't really limit how often or how frequently clients can talk to us. I think that's a mistake in the accounting industry, is Accountants, because they don't always understand how to run a business themselves. So they bill by the hour as a defense mechanism against, being overwhelmed with work, and at least they can bill their hours. That actually disincentivizes a client from reaching out. And a client that's reaching out is a client that needs help. And so why would I stop somebody from asking for help when that's where my business thrives, is in helping people, and that's how we get compensated. So really, at the beginning of the year, we sit down with everybody and we look at a proactive tax plan. We say, here's what you did last year. What do you think you're going to do this year? And then based on that, let's put some protocols in place that we already know we're going to use. And then throughout the year, let's stay in touch. Let's text, email, call. Let's make sure everything is on track. At the end of the year, after October 15th, year-end tax planning starts. So we kind of look at, all right, let's shore up your numbers on your profit and loss. Where are you at compared to where we thought you'd be at? And if you're way over, then we need to throw a couple Hail Marys before the end of this year. Just got off a call with a client yesterday where we're going to help him save about 50 grand in taxes this year. And it's all end of year stuff. He didn't realize he was going to have that much. He had a great 2020, more power to him. And so we're going to make sure before December 31st, we get the right strategies implemented.
Now, one other question I think I have to ask you, based on the year we've had with 2020 and COVID, is what can you tell business owners about business owners that took the PPP loan and taxes?
So I actually didn't study the PPP loan much. I looked at it as a government subsidy program, and it's not something I recommend or get involved in. So my knowledge of that subsidy is not very high, just because it's not something I use or recommend. My understanding of it is the expenses used with that PPP loan are not tax deductible. And I don't think most business owners know exactly what that means. I think what's going to happen is we have a lot of business owners that got the money, spent it, and then they're going to file their taxes and find out they owe a lot because they couldn't write off all those things they thought they could. And then I think also, the forgiveness protocols on that probably are not going to pan out the way people thought. I think when we get at the end of this, we're probably going to look back and see that there was probably billions of dollars of fraud that happened with those PPP loans, both on the small and large business level. So it'll be interesting to see how it pans out, is all I can say.
Yeah. I think that's the misconception, is that a lot of business owners definitely, there was a lot, depends what sector you were in. There was definitely business owners that if they didn't get the money, I think they wouldn't have survived. And you can argue,
oh, yeah.
Right or wrong, should the strong survive and the weak just go away, or whatever it is. But, I think that their thinking was they could take it and then it would, really, it was almost like a gift. And then really what's happening is, it's going to turn into income basically if they can't write it off. And then, they're going to get taxed on it, and, they can find themselves in a real pickle if they don't have the money, and they're going to have probably a bill that they're paying to the IRS over the next couple of years would be my guess.
Yeah. And I think a lot of those, it's either the PPP or the EIDL, depending on the loan size. You had to also secure it with personal assets. So a lot of people secured it with their house. And I think that that's going to be a whole new wave of probably people that can't pay that loan back. And, they end up with a second mortgage, or they end up having the U.S. Treasury become the owner of their home.
Yeah, that was the EIDL. Was that one was? Yeah, it was.
Yeah.
Yeah. And you're right. I don't think people realize that at all, that's kind of what was going on.
Yeah.
Yeah.
It's the IRS, right? That's not who you want to get into a lender situation with if you can avoid it.
Yeah, absolutely. And Jerry, where can everybody find you if they want to get more of you?
Yeah, so I'm on all social media platforms. So Facebook, LinkedIn, Instagram, Twitter. You can find me at Jerry Fetta. So that's JERRYFETTA. It's like the cheese with two T's. You can also go to my website, wealthdynamx.com. And you can get a copy of my book there. We have tons and tons of free content, articles, videos. We have a fantastic YouTube channel. So Google me and you will find me. And there's plenty out there.
And go ahead, plug the book again. Where can they get the book and the name of it and all that good stuff?
Yeah, so the book here, it's called The Blueprint of Financial Freedom. And you can get this on my website. If you go to wealthdynamx.com, You'll see a copy of that up on wealthdynamx.com. You can grab that. There's paperback, there's ebook version. It's perfect time for holiday seasons. If you order one now, we could ship it out to you, have it out there by Christmas, and you can give that as a gift as well.
Great. Now's the time we solve the equation to Jerry's success. This is where I get to ask you 7 rapid fire questions.
I love it.
Are you ready?
Let's do it.
All right. Best seminar or teaching you've ever been to?
Best seminar. So I went to a boot camp with Grant Cardone in 2017, I think. And the end of the boot camp, his chief operations officer, Sherry Hamilton, she stood up and she spoke. And that woman was one of the more genius, administratively minded people I've ever heard talk. And that was, for me, huge, because that's not usually talked about. Seminars are usually motivation and sales, not administration. So that was one of the best seminar segments I've ever sat through.
Favorite item you bought recently under $100?
Does it count if I bought several of them?
Sure.
Okay, a round of silver.
Gotcha.
I bought 500 of them, but one of them is a round. So
you're still buying at these prices?
I'm still buying them, yeah.
Okay. Favorite book to give as a gift?
How to Create Wealth, my little book.
Something you do every morning before you brush your teeth?
Usually go to the bathroom.
And your personal mantra or favorite quote?
Do it anyways.
Place you go to decompress and reset?
The gym.
Jerry, thank you so much for being on. I think our listeners, they got a wealth of knowledge, and I think they enjoyed it. I'm hoping they enjoyed it as much as I did. Best of luck with your book. We hope that it sells as many copies as you desire. And thank you so much for coming on today.
Thank you so much, Nick. It's been a lot of fun.